Good morning everyone and welcome to our HUBsights webinar today. I'm Anne McDonald, the Head of Marketing here at Hub24. During the month of October we've been showcasing all the great insurance options available on our platform, and today we're delighted to be joined by Ben Martin, Technical Manager from AIA Australia, who will be taking us through 3 tax-effective flow-on effects from the new rollover of death benefits. Before we start, just a few housekeeping items. The lines will remain muted throughout the presentation to prevent any background noise. So if you have any questions, please use the webinar control panel. Ben is happy to answer your questions throughout the presentation, so send them through as you have them. I'll now hand over to Ben to start his presentation. Thanks, Ben.
Thank you, guys. Welcome. Thank you for coming along. So my name is Benjamin Martin. I work within the technical services group at AIA, and just like any other techo, my job is to be across super and tax laws and to communicate those effects and changes to those laws and what it means as far as your strategic financial advice is concerned. Today what I want to do is shine the spotlight on a subtle change to the tax law that took effect from 1 July this year. Okay, and what I'm going to focus on in particular is how this new death benefit rollover rule, how it creates 3 flow-on effects and creates these 3 distinct advice opportunities that impacts those clients of yours that have life cover sitting inside their superannuation fund. Okay, so let me jump into this case study. So the easiest way for me to articulate the strategic impacts on your financial advice is to center it around a particular case study. So on your slide there, on your screen, what we're saying is, let's visualize you've got one of your clients. It's a mum and dad. Mum and dad have 2 children. They're minors under the age of 18. And your recommendation to say to dad is to take out $1.6 million of life insurance cover, and we've chosen for cash flow purposes to house that insurance cover inside dad's superannuation fund. Now mum and dad each had binding nominations in favour of each other, and the reason why you've struck a figure of $1.6 million is because the needs analysis has identified that the prevailing mortgage, the outstanding debt, currently stands at $800,000. But on top of that, we've decided to dial up the sum insured by another $800,000 to provide this future fund or this future pool of capital to pay for things like education, the education fees for the 2 minor children going forward, and to primarily provide coverage of dad's salary for a certain number of years should dad prematurely or unexpectedly pass away. So I want you to sit there right now and think, okay, well, what happens if and when this trigger event were to occur? Let's say dad suddenly passes away tomorrow. We've got $1.6 million of life cover sitting inside dad's superannuation fund. Obviously, in accordance with the terms of the life insurance contract, the life insurance company will deposit $1.6 million, being the sum insured, into dad's superannuation fund. But what I want you guys to think about is what your advice is to mum, being the surviving spouse, at that point in time, given that mum is indeed the nominee on the binding death benefit nomination form, in light of the objective here to clear $800,000 of debt, but most importantly, given this extra pool of capital that we've got sitting on the sidelines that we need to find a place to invest for. So on your screen there, what I'm trying to communicate here is if that $800,000 or if that $1.6 million was housed within a standalone risk-only superannuation plan, or indeed if it was housed within a self-managed superannuation fund, naturally we would be calling for $800,000 to be paid out into mum's personal bank account in order for mum to be able to clear the outstanding debt or that prevailing mortgage. Now, being a tax dependent mum is entitled to that $800,000 entirely tax-free, so she pays zero tax on that lump sum, and she just receives that and just pays off the mortgage. But the question here is, what do we do with that surplus $800,000 that we've dialed up to, which of course represents a future fund to pay for things like the children's expenses going forward. So that's the situation, and from 1 July 2017, as I was alluding to earlier, there have been subtle changes to the tax laws which would allow surviving spouse or mum in this instance to roll over the $800,000 from the standalone risk-only super fund or the SMSF to a platform superannuation fund, and by that we mean obviously a super fund that has underlying investments and accumulation interest that we can manage on behalf of the member. But it's the subtle change to the tax law from 1 July this year that now allows mum in this instance to roll over the $800,000 from the standalone super fund into a platform super fund for the purposes of purchasing or commencing an $800,000 death benefit superannuation income stream. Now, some of you are probably sitting there thinking, why would we want to roll over $800,000 from a standalone fund or indeed an SMSF? The response there is twofold. Remember, as a standalone risk-only superannuation plan, it doesn't hold underlying investments on behalf of the member. So technically, it doesn't have the infrastructure to be able to facilitate the payment of a death benefit income stream for mum directly from that fund. So naturally, we would have to roll over that amount to another super fund that can commence an income stream for mum in that instance. And pre-30 June this year, that $800,000 rollover just wouldn't have been permissible given the way the previous laws were worded. But that now changes from 1 July 2017. The second instance there is, imagine if that $1.6 million life cover, instead of it being housed within a standalone risk-only super plan, imagine if it was held within a self-managed super fund. In that instance, perhaps the objective there is for mum, to being the surviving spouse, to simplify her affairs. So perhaps mum doesn't want to have to be burdened with the ongoing obligation of having to manage that SMSF going forward. Perhaps dad was the more active member, a trustee of the self-managed fund, and a decision has been made in light of the objective there to simplify her affairs, to wind up the SMSF and roll it over to a platform super fund, which she is no longer obliged to manage the fund assets on as a trustee of her own super fund. So in those scenarios where we're looking to wind up self-managed funds, perhaps given the death of one of the more active member trustees, this subtle rule change from 1 July 2017 allows that rollover of the surplus $800,000 to a public offer super fund for the purposes of commencing a death benefit pension. Now, in terms of why do we want to go into pension phase, obviously in this case, we're within the $1.6 million transfer balance cap limit, so the capital sitting inside the pension will accumulate tax-free inside the pension environment. Likewise, each year, just like an ordinary income stream, that $800,000 death benefit pension will have to push out 4% of minimum pension payments to mum each year, and depending on the underlying componentry of the pension, she'll obviously have to pay tax on the taxable component, or at least, should I say, declare the taxable component of those pension payments in her tax return each year, but she does, of course, qualify for that 15% pension tax offset. So it can be a quite appealing structure to house surplus amounts of capital that perhaps stems from superannuation-owned life cover, in that it retains, and we're able to retain the inheritance or the capital inside the superannuation environment without having to push it through the estate and whatnot. So that's a viable option from 1 July in light of this rule change. So following on from that, from 1 July, the other subtle change is that we no longer have what we used to refer to as the death benefit period. So some of you might be familiar with this old rule, but in broad terms, we used to have this 6 months from date of death or 3 months from the granting of probate rule, and the later of those two dates, and that impacted the taxation of death benefit pensions, and it indeed prevented rollovers from occurring in the earlier instance that we looked at in the case of mum being the surviving spouse. Now, the death benefit period, what I'm trying to say here is that the death benefit period has been repealed from 1 July 2017, and that itself creates a number of strategic advice opportunities. And I just want to show you what those opportunities are. So here we have, again, following on from the earlier scenario, let's imagine that surviving spouse uses the surplus $800,000 to commence a death benefit pension from a platform, super fund, or indeed an SMSF, and that $800,000 balance is a prevailing balance on 1 July 2017. The surviving spouse was age 47 in this case, and the late hubby who died at the age of 50. That's important. We need to know that information because that then dictates the taxation treatment of the pension payments. So because they were both under the age of 60, we know that the taxable component of the pension payments is assessable income, taxed at marginal rates less than 15% pension offset, which means that if we draw 4% out in the current financial year being $32,000, part or all of that's going to be subject or will have to be declared in mum's personal tax return and taxed at her marginal rate less than 15% offset. But in this situation, the repeal of the death benefit period creates a value add opportunity for you and your clients that are in this particular situation. So let's imagine that in addition to the $32,000 pension payment, that mum needs access to an additional $50,000 of capital from this pension. Now, if that is the case, given the change to the law from 1 July 2017, if mum were to elect to receive that $50,000 amount from the pension balance as a lump sum for tax purposes, so in other words, we're getting on the front foot with the administrator and we're telling the administrator of the death benefit pension to distribute the $50,000 not as an additional pension payment, but instead as a partial commutation or withdrawal from the pension account. If we were to make that election in the current environment, given the recent changes to the law, mum would receive that $50,000 entirely tax-free. And that is because from 1 July 2017, as a result of this repeal of the death benefit period, the law deems that $50,000 partial lump sum as a death benefit for tax purposes. And because the recipient of this death benefit for tax purposes is a surviving spouse being a tax dependent, that gets pushed out to mum entirely tax-free. Now, those principles equally apply to those clients on your book that might currently, or that were in pension phase, death benefit pension phase, pre-30 June 2017. All right, so there's no discrimination but based on the commencement dates of the death benefit pension. And as you can see here, there's a significant opportunity for you to add value for clients in circumstances where they need additional access to capital over and above the prescribed 4% minimum for that prevailing financial year. Now, following on from that, so what we've said so far is that if you've got clients in receipt of a death benefit pension, there is scope for them to make this special election over and above the 4% minimum each year, which results in them receiving tax-free access to part or all of the capital. Now, with that, it also, what it does do, if you think about it, it does create what I like to refer to as an over 60 quasi-income swap strategy for these clients. All right, so if we know that clients have tax-free access to part or all of the capital sitting in a death benefit pension, then that means we can use that access to create an income swap strategy or a tax-free income swap strategy that otherwise would have only been eligible or available for those clients over the age of 60. So what we're saying here is you've got a death benefit pension recipient. Your advice is to salary sacrifice or indeed make personal tax-deductible contributions into super, which is obviously going to boost their retirement savings whilst minimising their tax impost or minimising the tax that they would have otherwise paid on the salary that would have otherwise been paid into their bank account, but to supplement their income as a result of entering into that contribution strategy, we're supplementing their income by electing to receive tax-free lump sum withdrawals from their death benefit pension account. So that's what, in essence, creates this quasi-income swap strategy that can be a very powerful way to boost the client's retirement savings over their remaining working years without compromising on the client's take-home pay and therefore creating this quasi-income swap strategy that wouldn't have otherwise been available to that client given the current laws. Okay, the final thing I wanted to discuss here is that if I know that I can roll over a death benefit from Super Fund A to Super Fund B for the purposes of commencing an income stream inside Super Fund B, and to the extent that the money sitting inside Super Fund A comprised of insurance proceeds, then the rollover itself creates these incidental estate planning benefits in that we're breaking the connection or the nexus. We're breaking the connection of a super benefit that otherwise has been boosted or built up by virtue of an insurance payout. So what I'm saying there is, ordinarily, when insurance is paid into a super fund, it forms part of the taxable component. We all know that, generally speaking. And to the extent that the ultimate beneficiary of the death benefit from that super fund is someone like an adult child being a non-tax dependent, then we know that there's going to be an untaxed element crystallised. But what I'm saying here is that if you were to roll over a super account from Super Fund A to Super Fund B following the death of the life insured, it breaks the connection with those insurance proceeds. So in other words, when Super Fund B trustee goes to pay out the death benefit to someone like an adult child, it has absolutely no idea that that death benefit comprises of insurance proceeds as a result of the rollover that it received 2 or 3 years ago. So that rollover is in essence creating this incidental estate planning benefit in that it's removing the crystallization of the untaxed element and thereby watering down the tax bill for the adult children who may or may not be intended or anticipated beneficiaries once the surviving spouse passes away. So that's the third benefit, guys. That's the third strategic incidental benefit that's crystallised as a result of this new death benefit rule that has taken effect from 1 July 2017. So it's 11:19, so I'm going to pull up stumps there. A couple of questions have filtered through, so we'll get to them shortly. But if you do ever need a second opinion on a technical matter down the track, you can contact me directly on those details on your screen now. Alternatively, we do have a dedicated advisor portal with a whole bunch of white papers, calculators, videos and tools and collateral that you also might find useful. You can access that information just by jumping into Google and typing in these keywords AIA techie. So I might hand over to you, Anne, just to flesh out some of these questions.
Yep, some great strategies there for advisors to use. So thanks, Ben. The AIA portal can also be accessed from the HUB24 website as well under our insurance options. So in terms of questions, would another option be to simply pay the death benefit into the estate for distribution into a testamentary trust?
Yeah, so look, that's certainly another viable option. But remember, the moment we start talking about testamentary trusts, where by necessarily we have to introduce a legal advisor or a solicitor into the equation. So that by its very nature is going to introduce an element of complexity, stakeholder management, and also, of course, additional fees for the client for having to draft the terms of a discretionary testamentary trust into the client's will during the lifetime of that individual. So it certainly is a viable option, but it does introduce complexity and additional costs. The point I was making earlier in the presentation is that arguably a more cost-effective way of managing surplus capital where we've dialed up the sum insured and perhaps introduces or perhaps just keeps things a lot more simpler for the client is to explore the option there to house the surplus capital in the superannuation environment via the commencement of a death benefit income stream. So I'm not entirely discounting it, but what I'm saying is in the spirit of keeping things simple for clients and keeping costs to a minimum, really your first port of call should be the death benefit pension option.
Great, thanks, Ben. Sounds like there's a little bit of complexity with that option. Another question which comes through is the death benefit pension restricted to 10% per annum, given the surviving spouse is under preservation age? Yeah,
look, we get that question a lot. So in our example, the surviving spouse was age 47. So clearly she's under preservation age. But just remember, when death occurs, the money sitting inside the deceased superannuation account is converted to unrestricted, non-preserved benefit. So that means the recipient of the death benefits, in this case being the surviving spouse who has opted to receive it via the commencement of an income stream, has a death benefit pension. In that case, it was $800,000, and that capital, as reflected on the rollover benefit statement, would have all been unrestricted, non-preserved component, which means that mum in that instance would have had full access to the capital irrespective of her work status and irrespective of the fact that she was under pension preservation age.
Okay, fantastic. So I think that's all the questions for today. Thank you very much, Ben, for joining us. And Ben has given you his contact details in the presentation there, but HUB24, our BDMs, are also happy to facilitate contact with AIA should you wish to get in touch with them. Thank you very much, and we look forward to hosting you again at our next HUBsights webinar.